morning. Welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Menaka Doshi.
And you're watching Indian Open, and I'm Neeraj Shah. Good morning, Menka. Good morning to all the viewers. Seems to be a packed week.
Yeah, it's going to be a packed week. I think one of the busiest weeks we've seen this month for sure, because next week is a truncated week, isn't it?
Well, that too.
Yeah. So we're counting down to the next long weekend in March. Lots to look forward to. Asia, though, opening a little weak today.
Yeah, and the SGX Nifty too showing signs of reaching those very crucial levels near the all-time lows, near the moving averages as well. So all of that will be in focus today.
All right. Let's get straight to the headlines. Vladimir Putin will lead Russia for another 6 years after securing an expected victory in Sunday's presidential election. This is his fourth term. Yi Gang is poised to take over the leadership of the People's Bank of China. That's the central bank in China. This from longtime governor Xu Shaoxuan. And this is according to a Wall Street Journal report. The Indian National Congress sets its economic agenda. The focus is on jobs, education, healthcare, and the revival of the manufacturing sector, as well as exports. Those are the big stories we're opening the day with this morning.
Yeah, and let's talk about the trade setup for the day as well. Mind you, we can also talk about the trade deficit, of course, and the way it's widened. But I think that was on expected lines. Almost everybody that we spoke to off air as well, post the data coming out, mentioned that this is on expected lines. So nothing too dramatic out there. Yes, it's not a number that people like, but it's a number that a lot of people anticipated to come about as well. So the trade setup for the day, I think our benchmarks now seem to be a little bit decoupled from what's happening across the globe. It kind of showed signs of that in the latter half of the week. But if you look at what's happened in the month to date and the week to date, so if you look at the weekly data, you will think that the Nifty and the Sensex, I don't too much talk about how last week was so strange compared to what was happening to the world. Hey, look at last week. The weekly change, we haven't done too badly. In fact, Dow Jones cracked a lot more than we did. And the other markets, well, 0.2, 0.8, 1.4% odd for Kospi and Hang Seng. That's not really dramatic decoupling. But look at the month-to-date. I just want to again go back to the previous slide. And then look at the right-hand side column, the month-to-date numbers. The Sensex has corrected 3%. Look at what the other markets have done. Dow Jones, very, very flat. Straits Times, very, very flat. Hang Seng and Kospi have actually gained 2%, up for Hang Seng, almost 2.7% for Kospi. So month to date, in the first 20 days of the month of March, there has been a serious underperformance by the Indian markets, almost to the tune of 5% to some of the other peer markets in the Asian region. Now that is seriously underperformance. And I know a lot of talk, Menka, about what's happening and why is this happening. But one simple thing that stands out, the flows, the DIIs month to date have put in only 300 crores to work compared to what each of the previous months for the last 12 or 14 months have been. And there's a serious underperformance on the flows front. So FIs have net bought 8,000 crores, DIs only 330 crores. That's the problem for our markets. Because of the dividend policy and the want to give out the dividend to the investors, DIs have been net sellers in the month to date. So there are fresh flows coming in, but DIs have been selling in order to pay off the dividend, and which is why the money coming into the markets has not been that great. So that's the problem. May change in the month of April, but let's wait and watch. I think political chatter will dominate the early half of the current week in India. Today is an important day on the political front as well. In all probability, Menka, the no confidence motion, even though it may not yield results per se, but it's an important one to look at as well.
No, undoubtedly. I think we'll see how Parliament deals with that. We've seen disruptions in Parliament over the last week and nothing come of it. But let me not say more on the politics of the day because there's lots to discuss. That's what the market setup looks like. Here's a quick look at what we have for you on First Word this morning. How the commercial vehicle scrappage policy, which is being reported about, could boost sales for Ashok Leyland and Tata Motors. We'll also talk about the latest kid on the block, Sandhar Technologies. Somit will tell you about that auto ancillary company's IPO. And on the political front, this is something we're going to keep coming back to, I think, for the next 1 year. Well, over the weekend, the Congress released its economic resolution, this at the end of its plenary session. So we'll talk a little bit about what the Congress's economic strategy is going to be going into the 2019 elections. And we'll also get you an expert political voice. Aditi Farnis of Business Standard will be joining us with her take on what she makes of the developments over the weekend. Let's kick it off first with the IPO rush.
Yeah, let's start off with that. It's actually been the week of IPOs. 3 or 4 large issues, one more starting off this week. And the second week, auto ancillary company Sandhar Technologies heads to the primary markets. Sumit Sarkar is here to tell us all about this issue and what's on offer and what should an investor or an average investor do with this IPO. Good morning, Sumit.
So this time it is Sandhar Tech, an auto ancillary company. The company is looking to raise as much as 512 crore rupees in this IPO at a price band of 327 to 332. And at the upper end of the price band, that is 332, the market capitalization of the company would be close to 2,000 crore. Now, this amount is wrong, but it would be close to 2,000 crore rupees. Now, if you see, the IPO is a combination of an offer for sale and a fresh issue. Now, in this offer for sale, investor called GTI Capital will be exiting from the company completely, while the company is raising close to 300 crore rupees as fresh issue, which will be used for debt repayment and for general corporate purpose. Now, this graphic is a bit wrong, but out of that 300 crore rupees, 225 crore rupees will be used for debt repayment and the remaining for that. Now, it's an auto ancillary company largely focused in making two-wheeler locking systems and rear view mirrors and not market. So it's rear view mirrors. Now it also focuses on
rear view market. Sorry, Sumit, but anyways, go ahead.
It also focuses on wheel assembly, sheet metal components and aluminum components. Now it has 31 manufacturing facilities in 8 states of India. It also has 2 manufacturing facilities in Spain, 1 in Mexico, and it is in planning phase to commission 5 more facilities in India. So you can see the kind of growth that the company has going forward. Now if you see, the company has among the top 5 clients of the company, that is Hero MotoCorp, TVS, it's not Hero Honda, it's now only Honda, then Bosch, and then Royal Enfield, that is Eicher Motors, contribute nearly 70% to the company's revenue. Now the company also has small exposure to Europe market. It gets around 12% of its revenue from there. Now if you see, product wise, the company generates most of its revenue by selling locking systems, but it also gets some part of its revenue from selling aluminum and metal components. Now, if you see, if you compare it with its peers like Minda Corp and FIM Industries, which also manufacture the same products, that if you can get the next plate. Okay.
Just wondering. I mean, how is
yeah? We just kind of definitely not cooperating with you this morning. Yeah.
But auto ancs seem to be in a sweet spot now. If we just try and compare Sandhar with what the other peers are doing, how does it stand up?
So there we have it. So if we compare with Minda Corp and FIM Industries, which are also included in the manufacturing same components that Sandhar Tech manufactures, the growth rate of Sandhar Tech was but muted. Its revenue, net profit and EBITDA have grown at a compounded annual growth rate of 9%, 6% and 8% over FY14 to FY17. And you can see the how Minda Corp has grown over the same period, 23%, 7% and 17%. FIM Industries bottom line growth rate was not that good, but you see the top line and EBITDA, the growth rates are better than that of Sandhar Tech. On the balance sheet side, if you see, now the book value per share of Sandhar Tech would be close to 104 rupees. That would be on listing because 300 crore is coming to the company. And its total debt to equity is currently 1.5 times, which has come down to 0.4 times as the company is using the IPO proceeds to repay its debt, which would be lower in the industry when compared to Minda Corp and FIM Industries, which have a total debt to equity of 1.1 times and 0.5 times. On the return ratio side, the return ratios of the company were a bit subdued. The return on equity for an annualized basis for FY18 was around 11%, return on capital employed was 17%, and return on asset was 5%, which was lower when compared to its peers like Minda Corp and FIM Industries. On the valuation side, if you see, on price to earnings on annualized basis for FY18, it is at par with Minda Corp, but expensive when compared to FIM Industries. Market cap to sales 1 times, which is at par with FIM Industries, but cheaper when compared to Minda Corp. But on EV to EBITDA basis, which is kind of more important, it's 11.1 times. Now this is cheaper when compared to Minda Corp, but expensive when compared to FIM Industries. Lastly, on price to book, it is 3.2, while where Minda Corp is 6 times and FIM Industries is 2.6 times. Lastly, if you see brokerages, now among the top 4, 3 have a subscribe rating for this IPO and 1 has an avoid rating because of its expensive valuation, inconsistent financials, and Prabhudas Lilladher, which has given an avoid rating, says that there's no growth going forward in this company. Well, these 3 have a subscribe rating because they're saying that the valuations are cheaper when compared to its closest competitor, that is Minda Corp, and the growth rate of the company going forward could be good because of the various its product portfolio that the company has.
I think the only question is whether or not in the listed auto component space there are enough players available which beat the growth of Sandhar Tech. And frankly, this comparison with Minda, even though Minda sounds a lot more expensive, but that's with a reason. The way Minda has performed over the last 3 years on its sales growth, on the customer acquisition, and the feedback that people say that they get from Minda's customers about the work that Minda Corp is doing is quite fabulous. So one is the kind of growth that Minda Corp is anyways putting out, and which is why it's got premium valuations compared to a lot of other peers. FIAM, I think, has been going through a rough patch the last 12 or 18 odd months.
Was good for the company.
Yeah, and FIAM has also moved on into LED lighting in a big way compared to being a pure play auto and company. So there's a bit of a change there too. But interesting, after some time, we are getting an IPO in the auto component space, but more importantly, we are also getting an IPO in the last 4 or 5, wherein the opinion of the street is divided. Hitherto, last week, almost all the IPOs had either subscribe for the long term or subscribe. This time around, we have enough brokerages who are also mentioning that they would recommend an avoid on the IPO as well, Sandhar. Right?
Last week, in fact, all the IPOs had a subscribe or a subscribe for long-term rating. This is the first one that I've seen with an avoid rating after actually a very long time. A brokerage coming out with an avoid rating. Most of them earlier were a neutral rating or a subscribe rating.
Seems okay.
Okay, that's how Sandhar stacks up. Thanks, Amit, very much for that. Let's move on. The government may have given an in-principle no to the commercial vehicle scrappage policy. Now, that's according to a report in the Times of India. In addition to the environmental benefits of this policy, what could the impact on automakers be? Mostly beneficial, as Yatin Motor has put together. Here is a quick roundup of what brokerages are pricing in if that policy were to be put to work. Yatin?
Well, Menika, we need to just inform our viewers that the scrappage policy, no official document or no official communication from the government has yet come. In fact, what we are gathering from news reports is that after the Ministry of Road Transportation and Highways, approved the scrappage policy, we have the Finance Ministry, which approved the proposal of, a benefit when it comes to the GST taxation on trucks comes as far as scrapped trucks are concerned. Now, what Times of India report is suggesting that the Government of India and the high-level PMO office meeting has, given an in-principle nod to the scrappage policy for trucks having life of more than 20 years. The trucks which are already operating, which have completed almost, 20 years in service, will be eligible for the scrappage policy. Now, the scrappage policy broadly, gives a benefit of nearly 10% on the GST paid, which means that, when you buy a new truck, you ideally pay a GST of 28%. But since you have scrapped your old vehicle, you get probably 10% benefit, which, the reports again are suggesting. So the effective GST taxation on the new truck after scrapping the old truck would be close to 18%. Now, various brokerages like Morgan Stanley have come out with their initial assessment of the scrappage policy and the kind of volume that they can generate for commercial vehicle players like Tata Motors and Ashok Leyland. They say in their recent report that from a period of 1992 to 2003, the period we are talking about, wherein the average life of vehicle would be anywhere between 20 years to 15 years, nearly 10 lakh to a lower number of 4 lakh, that is the range, 4 lakh to 10 lakh is the kind of vehicle which will be immediately available for scrappage, since the government plans to implement the scrappage policy and not allowing trucks of over 20 years to be on the roads, from April 2020. So this is the kind of volume that the market can get immediately. Now they say that scrappage induced demand could support sales visibility beyond 2020 and would help such a highly cyclical business or a sector to benefit. In fact, they say that the commercial vehicle players could see improved capacity utilization moving forward. So Morgan Stanley expects that Ashok Leyland's capacity utilization, once the scrappage policy is in place, could improve to a level of 96% in FY20 versus the current utilization of 84%. Not only that, they believe that this will have a significant impact on the earnings of Ashok Leyland, since it will provide a 15% volume improvement on a bull case scenario, which will improve their earnings by 24%. So 15% growth in volumes because of scrappage policy increases the earnings for Ashok Leyland by nearly 24% in the year FY20. And Tata Motors capacity utilization, according to Morgan Stanley estimates, is expected to improve by nearly 20 percentage points. So this is the kind of initial impact or assessment that brokerages are talking about. We don't yet know the contours of the scrappage policy. Will it be applicable on 15 years of 15 years old truck or 20-year-old truck? If the certificate which is issued for the scrappage is transferable, there are a lot of questions, including what will be the exact GST rebate for a 20-year-old truck to a 15-year-old truck. But clearly, broadly, a 10% kind of a GST benefit plus a sunset date of April 2020 is what most of the news reports are suggesting at this point in time.
Okay, interesting. Many thanks for that, Yatin. We'll watch out. Let's see. There's some bit of pushback, or rather push coming in for CVs across the last 12 odd months in the form of scrappage policy, EVA bill. Otherwise, let's wait and watch what this does to stocks today. But this
politics to talk about. Yeah, I think we're going to wrap this up with an event that you cannot ignore. And whilst it may not be immediately market moving, if we're counting down to elections, and I think that countdown has started already to the 2019 general elections or Lok Sabha elections, then I think the Congress has made its position very clear over the weekend where it held its plenary session. You heard Rahul Gandhi's speech there. But more importantly, from a business, economy and markets point of view, they've put out an economic resolution document. And I thought that it might be interesting to spend a couple of minutes talking about that before we get to Aditi Fadnavis for her views on both the document and Rahul Gandhi's speech. Now, I think I've picked up 5 key takeaways from this. I think the first salient feature of this document is that they've listed 5 big challenges, and those 5 big challenges are pretty much on the mark. And I'm not surprised by that at all, because it's very tough to get that wrong in this country. The 5 big challenges that the Congress party has identified as challenges for the economy and challenges that they hope and promise to fix are jobs, education, healthcare and a social safety net, agrarian distress, robust credit growth and reviving the manufacturing sector, and steady growth in exports. So that's the first one, fairly simple there. Now, the second one is a little bit more of an opinion as opposed to, what's in the document. There seem to be some green shoots of policy discontinuity. Those are not my words, those are Raghav's words. So actually, if you do visit BloombergQuint.com, on our website, you can read Raghav's entire analysis of this policy document. And here's what he takes away. I think just to give you one glimpse of why he thinks there are green shoots in terms of policy discontinuity is the fact that there has been a stress on the private sector and its participation in the economy in the document. I think at one place the document says the Congress resolves to win back economic freedom for India's entrepreneurs, which is a big statement coming from a party that was rooted in socialism for very, very long. So he's taken that as a very heartening statement. The other one where he's spoken of, which he thought was heartening, was the goal to become a middle-income developed country. It's the path to lifting the poor out of poverty. It's the path towards creating a large, vibrant and productive middle class. And then the document goes on to say it is the path to creating wealth. Now, creating wealth is not something that you'd necessarily associate with the economic goals of an erstwhile socialist party. But, that's where I think Raghav found considerable amount of encouragement in the document. Now, let me give you some of the flip side or the downside to the document. It does still seem to be that the Congress is living in denial of its poor policy making in the past. And I say this using just one example, though there are many. The document is littered with many examples to support my key takeaway. But that example is this statement. The document says the starting point of the banking crisis was the unwarranted criticism of telecom, coal and power sector policies of the UPA government that was trumpeted by the BJP, blah, 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 blah. Now, I'm not sure how the Congress is hoping to defend its discretionary allocation policies, that plagued these sectors, and when its own Prime Minister of the time had wanted to move to an auction-based policy, but could not because of the political pressures. So what are you really defending, guys, right? That's my question to the Congress. And how can you blame the criticism by the opposition of those policies when the policies themselves were grounded, in poor decision making? So I thought that is an illustration of how the Congress still seems to be living in denial of some of its poor policy making in the past. Point number 4, or key takeaway number 4, no mention of a smaller public sector. You know, I think what won my or captured my imagination with the BJP government was the minimum government, maximum governance phrase that Prime Minister Modi, you know, sort of used in his campaign. Unfortunately, the BJP has not delivered on it. This document by the Congress makes very little mention of a smaller public sector. It talks about the public sector in new words, which is great, competitive, etc., but it doesn't say anything about shrinking the public sector, and I thought that was a little bit of a disappointment. And finally, it's lacking in detail. You know, it's a lot of big picture, you know, apple pie, blue sky kind of stuff. It's also lacking in any new ideas. It sort of sticks the tread-in path, and when I say tread-in path, I'd say, yes, those who know the Congress from the 50s, 60s and 70s will come away pleasantly surprised. But we don't live in the 50s, 60s and 70s. Yeah. So this party needs to be not just different from what it was 50 years ago, 30 years ago, but it needs to be different from what is being offered today in terms of words, right? Of course, in action as well, but also in terms of words. And I didn't find that great distinction at all in the document. Now, this is a lot of opinion. I'm not reporting on the document strictly, but let's get expert opinion on this because this is mine. Aditi Fadnis, the political editor at Business Standard, joins us this morning. Aditi, a quick question to you first on the economic resolution document and whether it stood out for you as a document that speaks to a new India.
Well, what is a new India? I also belong to a new India and so do you. And there are at least 50 years separating me and you. I mean, give or take a few. So it's not new India. There has to be continuity in policy. I think you have very intelligently analyzed all the takeaways that you have done, but some of them are not rooted in reality. You want too much too quickly, and that's not the way India works. We know that. Frankly, I think it's many, many years since the Congress thought of itself and others thought of the Congress as being a socialist party. Socialist in India means statist. And I think the Congress gave up its attempts to be statist quite a long time ago, specifically from the time that the whole privatization stroke divestment program was initiated in 1991. So let's not get involved in isms. I think some of the things that they are revisiting with considerable candor is quite interesting. The fact is that despite the license quota system in, say, coal block auctions, in coal block allocations, we are now faced with a problem of plenty. So clearly, the auction route is maybe not the best route. And there you have to give credit to a party that is so ancient that it is willing to revisit its own premises. And ask itself whether this is the right way to go for India. Frankly, this is a lot more than what the BJP did when it unveiled its manifesto before 2014, where again it was, era of Amrit Varsha and all that kind of stuff. So the Congress clearly from this document is giving it a lot of thought. There's more that is unsaid than what is said. But whether it's what we want to hear, maybe not, but at least it's thinking about some of the problems rather than admiring them.
Aditi, the counter argument to this being a very robust document would be what Menka also just said, right? That seems to be a bit of a denial mode into some of the, give or take, I mean, ignore my term that way, but shoddy policies. One thing is to not speak about policies which have led to some bit of stalemate in a sector. The other is to come out and say that it was not our doing and being in the denial mode, which is not exactly the best option. But they have chosen to go down that path.
No, but I mean, what would you have them do? They're a political party. Would you have them say that everything we did was wrong and we are going to start all over again?
Mention things which were glaring in the eyes of almost all of those key sectors which were plagued.
But do we know what was glaringly wrong? Do we know now after the Supreme Court has, after the court has acquitted Mr. Raja of any wrongdoing, do we know what exactly went wrong? Do we know why?
I'm not sure I'd agree with that argument, Aditi, because I think criminal conspiracy or criminal charges of corruption are difficult to prove, and whether they got proved or not should not be conflated with the fact that we did suffer for many, many years a discretionary allocation policy when it came to natural resources, and that was a breeding ground for corruption. I'm sure if you've read the coal, order or the telecom order, and I'm sure you witnessed yourself the fact that many of these licenses were given out to companies, especially in coal. It was shocking the way licenses were given out to companies that clearly had political friends. So anyways, I think there can be many views about the document. What I was wondering, and I think the key question both Neeraj and I are asking you, is whether you think that this document represents a resurgent Congress, and a Congress that has revived itself enough after the lethargy of the last 4 years to make it a real battle in 2019. And that can be drawn, that decision, your answer can be drawn both from the economic resolution document as well as what you heard of Rahul Gandhi's speech yesterday. What did you make of it?
I would certainly, I think the Congress internally is giving all these pressing problems a great deal of thought, which is heartening. Whether they're right or whether they're wrong, and how they will roll out their prescriptions for fixing problems in the Indian economy, it's a different matter. But the fact is that we have to recognize that everything is not hunky-dory. There are serious problems, and we need people to think about them. Now, I got the impression from Rahul Gandhi's speech, as well as Mr. Chidambaram's speech, as well as other speeches, that there is a lot of thought going on into not just why we lost the elections, but have we done the right thing by India? Have we done what needs to be done? Are we going to do what needs to be done in the future? And yeah, it's all motherhood and apple pie, jobs, ending parent stress. There are actually even hints that the Congress may go back to the idea of loan forgiveness. I mean, Mr. Chidambaram mentioned that in his column, which is a kind of a abbreviated version of the document. So I think there's a lot happening in that party. There's a lot of thinking going on, and we should not dismiss it simply because it's a party which is going deeper and deeper into the opposition and apparently shrinking in political space. Thinking is not the monopoly of a ruling coalition or a ruling government. All thoughts about how India's problems can be solved should be welcomed. And some amount of candor in review also helps a great deal. So I think we have to go into as much the party didn't say as much as it said. And that's a very important element, which more investigation, inquiry, questioning from party people, by people like you and me, will help.
All right, Aditi, we'll leave it there. Thank you very much for joining us this morning. Aditi Fadnis, the political editor at Business Standard, weighing in on what she made of that economic resolution document and Rahul Gandhi's speech. Whatever you make of it, interesting times. It did sound like a far more charged Rahul Gandhi at the podium than we've seen in a long time now, right?
Yeah, to be fair, yes. But more on that during the course of the day, and some of it on our website as well. Raghabal's column on the website too. So do visit www.bloombergquint.com to read that. But that's all that we have on First Word today. A quick heads up of what else we have lined up on the show. Rajat Jain of Principal PNB Asset Management to join in and talk about this absence of the DI flows into the market. That's really the reason why we've got a domestic institutional investor coming in today. We talk about the dynamics of the IndusInd Bank Bharat Financial merger and the recent news flow with the MD and CEO MR Rao, and 2 or 3 big moves coming in the Mumbai and the Maharashtra real estate space. A couple of gentlemen join in and weigh in on that. Gulam Zia of Knight Frank as well as Anuj Puri of Anrock. All of that coming up. Stay tuned.
आइसक्रीम ये है डबल आनंद, पहला आनंद पॉलिसी टर्म के अंत पर मैच्योरिटी क्लेम का पूरा भुगतान और दूसरा आपके अपनों के लिए लाइफ कवर की पूरी रकम बिना किसी प्रीमियम के। LIC न्यू जीवन आनंद, आनंद ही आनंद।
सॉरी, आई एम लेट। क्या हुआ?
कुछ नहीं यार, जस्ट वर्किंग ऑन माई एक्सपेंशन प्लान।
फंडिंग का चक्कर।
इट इज सो फ्रस्ट्रेटिंग. I feel like banging my head against the wall.
No, don't bang your head. Cross the bridge instead.
Bridge?
हाँ, ये देख. ला.
अरे.
This bridge gets you in touch with interested investors. Funding happens, which means more outlets, more customers.
Interesting. And what exactly is this bridge?
A stock exchange created for your kind of company. Just list on it and help your business expand.
Really?
Yeah.
तो फिर लिस्ट कर लूं?
और क्या? शुभ काम में देर किस बात की? चल।
हाँ।
NSE Merge, साथ हमारा, सफलता आपकी. The SME Growth Platform from India's largest stock exchange.
White shirts, कितने plain और simple. Fog scent, plain और simple white shirt को बना दे special और fashionable. Fog scent, new fashion wear for men.
Welcome back. You're watching Indian Open with us on Bloomberg Quint. Let's do a check of the Asian markets. Remember, the start was pretty much weak, but a mild bit of recovery has been seen from the lows. So Nikkei is still trading in the red on back of firmer yen, but there has been a recovery which has been seen for the Japanese market, still trading, however, with deep cuts of nearly 200 points. The Hang Seng Index is now trading in the green with gains of nearly 100 points, and Shanghai is also just marginally in the green as we speak. Let's just pull up SGX Nifty, which is currently quoting above the mark of 10,220 right now. Remember, it was trading below 10,200 a while back. Cuts of nearly 14 points, telling you the start still will be negative. Important to actually monitor how the day progresses, because on Friday we did see selling coming in across the day. But what sort of cues are stacking up when it comes to the futures and options market? What sort of levels one should watch out in today's trading session? Let's go across to Darshan Mehta. Hi Darshan, good morning. Well, aggressive call writing seen on 10,200 and 300, and we also saw fresh shots building up for especially Bank Nifty.
See, that is right. See, two things I want to point out, and from one is the fact that what we saw for the last week is that selling accelerates to the second half of the day. So a 15-point gap down does not mean that it's all well. And 10,200 is the most important level. Now I'll tell you when. But first, let's see what happened with the Nifty. 4% open interest build up on the Nifty on the short side. The index was down almost 1.5%. Similar amount of selling was seen on the Nifty Bank. Here, high open interest build up of 12% was seen. Now, if we take a look at what happened, now call writers are active from levels of 10,200 right up to higher levels, and put writers are active at levels of 10,200 and lower. So we are pretty much at this level currently. What is happening is there is high amount of resistance or support coming in for the Nifty at 10,200. So if 10,200 is taken down today with force, we might see heavy selling that will come in probably to levels of even 10,100 or 10,000. Now see what happened on Friday. You can see, as Navneet was pointing out, aggressive call writing at 10,200 and 10,300, and put writers are running for cover. So if the market is going below the 10,200 mark in trade, again this number will go up and there will be more shedding of open interest, because even on Friday there was put writing happening at the 10,200. So watch out for 10,200 if it manages to hold or if it's taken out with aggression today. Now in terms of the PCR, the Nifty PCR fell in from 1.23 to 1.09. The Nifty Bank moved from 0.92 to from 1.05 because of the Nifty Bank expiry. As far as the FNO futures are concerned, stocks in the FNO band, these are the new stocks that have come in the FNO band. One of them is HDIL and the second is IDBI Bank. There are two other stocks which have come new in the FNO band, that is JP Associates and SAIL. Balrampur Chini comes out of the FNO band, so that is something, this is a mistake, so it's Balrampur Chini which is coming out. So Engineers India, for one, saw fresh short positions that were taken on high open interest build up of 14%. The other stock in focus is Reliance Infra. Again, high open interest build up and and fresh short positions seen on the counter. The other stock in focus is ONGC. Again, decent open interest built up for a large cap, and the counter was down almost 1.5%. And finally, IT Tech saw long unwinding. It's been gaining. It was trading at fresh 52-week high. From hitting levels of 1,000, it's moved back to levels of 930. So long unwinding was seen. But most important, watch out for 10,200. If that gets taken out by force today, you might see the selling aggravate in markets today.
Let's wait and watch. Thanks a lot for that, Darshan. So that's the view. That's the FNO indicators for the day today. Now that we've set up the trade for you for the last 35 minutes, let's get in experts in on the discussion to talk about how are they viewing the current market scenario, specific pockets of strength, weakness. Girish Pai, co-head of equity research at Nirmal Bank Securities, or institutional equities, excuse me, joins us right now in the studio. Good having you, Girish. Thanks so much for joining in. It's been a while between then and now, and I don't remember when the then was. How is the mood change? What's your thought now at your house about what could happen in the near term?
So near term, I think there are quite a lot of macro-related issues. I think globally there are issues connected with monetary tightening, where people are not very sure whether we're going to have a 3-rate hike situation or a 4-rate hike situation in the US. Then there are issues connected with tariffs that President Trump has levied or will potentially levy on China, because that's probably a few weeks or a few months process, and we don't know what kind of retaliation that China is going to induce. And we don't know what the ramifications of that are in terms of global growth and stuff like that. On the domestic side, I think macros have been kind of weakening, I would say, from a inflation standpoint, interest rate standpoint, fiscal deficit. All those are kind of, worsening, except for the fact that growth is kind of picking up. Things are not looking too great on the macro side. Lately, I think, at least if you look at what happened on Friday, I think political situation is also taking a turn for the worse in one sense, because a year back when the UP election kind of was won by BJP by a thumping majority, there was this expectation that 2019 was already in the bag. But now I think there are a little bit of questions being asked whether that's actually the case, whether we might have BJP winning a majority, but would it be a coalition government where some coalition partners would arm twist Modi and co into doing a whole lot of other things. So that's what the worry the market has right now. And obviously earnings picture is improving. But even there, I think there are certain wrinkles. I think the issue on the corporate bank side is still not very clear, whether corporate banks' earnings are going to improve in FY19 or whether that's going to be back-ended in FY19 because of the new regulations that RBI has kind of brought forth. So those are I think the things that we are kind of looking at. I think until the financials actually revive, I don't see the market actually creating a new high.
And you don't know when that will happen?
I think that will take at least...
I mean, nobody knows when that.
Yeah, I think that will take at least a couple of quarters, because March quarter is going to be a washout from an earnings standpoint. There's going to be a lot of provisioning. There could be kitchen sinking by the PSU banks and some of the corporate banks, other private sector corporate banks. And then you have to watch whether 1Q of FY19 will see further provisioning, higher provisioning. So once that is out of the way and the cleansing has been done, maybe that could be the time to start looking at financials, and the revival of the market could potentially be 3 to 4 months away, is the way I look at things.
Do you think because of all of these factors you've just highlighted, and especially related to Q4 earnings of the bank's investment cycle once again could be hit?
Well, we've not had a revival of investment cycle, so to speak. I mean, it's not as good as what it was between the 2003 to 2007-8 time frame. Except certain pockets like roads, and those are the areas which have done well. So it's very selectively investments have kind of picked up. I think revival investments will take a while. If you look at the capacity utilization in various sectors, say cement and some of those, they're still at very low levels. So I think it'll take capacity utilization to come up to reasonable levels a few years. Having said that, the question to be asked is the banking system in a situation to actually start lending? Maybe not. So, the healing of the banking sector will probably take 2-3 years. I think the PSU banking space will still be under a little bit of pressure in terms of whether it'll have the capital to actually grow.
If you're back to that old narrative of it's going to take 2 years or 3 years, in light of all of that, when everyone was talking about earnings growth to finally come in FY19 of between 15 to 20%, do you think we'll actually achieve that?
Yeah, so if you look at even year on Bloomberg consensus estimates for Nifty, I think that's looking at something like 24-25% Nifty earnings growth happening in
the
FI.
The upper end I heard from one of the analysts was 22 or 23%.
Yeah, the numbers which are there on your screens are something like 24, 25%. Yeah. I doubt whether that kind of number is going to be achieved, because I think the provisioning numbers on the corporate bank side is still not put into the estimate. So once that happens, my sense is the number is probably going to come down to maybe 15 to 20%. So I think there is going to be an earnings revival. Probably for the first time in like 4 or 5 years, you're probably going to see index level earnings growing in the double-digit territory, fairly strong growth. So if you take out a couple of sectors, I think if you take out the PSU bank space and the private corporate bank space, my sense the earnings revival is actually happening. Even now, it's kind of ongoing right now. So I think with the GDP growth going to maybe like 7.5 to 7.7%, which is what we are anticipating, we think that earnings will kind of recover fairly strongly next year, except that these couple of pockets that I talked about.
Okay, we'll get you more views from Girish going, but let's also do a check from our research team, which are the stocks which will be in focus when the markets open on back of some news. Some very important bulk deals which took place on Friday. We'll highlight that for you, and also a view on the cement space, and especially Ramco Cements. A brokerage note has come today where they've upgraded the counter with a 25% upside. Good morning to all three of you. Let me start off with you, Shraddha. Which are the stocks which will be in focus when the markets open today?
I mean, a lot of mid-cap names actually. Now, Gujarat Fluorochemicals has approved an offer for sale for 6.1% stake of Inox Wind, and that will be at a price of 115 per share. That's lower than Inox Wind's closing price of about 120 odd on Friday. Sona Koyo Engineering's promoter JKT Corporation will sell 4 million shares today and tomorrow via an offer for sale. Watch out for that name. Z Entertainment has called off their deal to buy 9X entities. You have TV Today, where they have said they will sell 3 radio stations to Entertainment Network India, that's Enel. 2 names in the back of order wins. First, you have Thermax. They have won an order of about 503 crores, and then PNC Infratech has emerged as the lowest bidder for a 1200 crore Aligarh Kanpur project. Also watch out for Max Financial, where they will be raising funds for making investment in their subsidiary Max Life, and that board meeting will be on 21st March, so we will continue to track that on the back of developments there. And lastly, according to a PTI report, IFCI has said that they're expecting cash recovery to increase to 1200 crores this fiscal. In the 3 quarters of this fiscal, they've already made about 800 crores. So some aggressive, as far as recoveries are concerned, so IFCI as well.
Let's see if the stock recovers or not, because I remember on Friday it was down nearly 4 to 5%. Yeah. Over to you. Key bulk deals, buying continues in HEG and Graphite?
Absolutely. So first up on bulk deals, we have Gateway Distillery Parks, when promoter Prem Kishan Gupta has bought 1 million shares or nearly 1% stake, while Morgan Stanley have sold that many shares. Moving on to Team Lease Services, HDFC Mutual Fund has sold 2.2% stake in the company, while the same has been bought by JF India Fund. So we are also tracking key bulk deals by Vanguard Group. Now they bought close to 1% stake each in Graphite India, HEG, Capital First, as well as Eris Life Sciences. So do keep an eye out on all these names. Now moving on to MV SCIF Mauritius Holding, which is a US-based asset management company. They have bought in 0.5% stake in Mastech. And lastly, according to an exchange notification, Porinjo Valiat's equity intelligence firm has bought close to 0.35% stake in Vahatech Wabag. So we may see some reaction there as well.
Okay, so watch out for all these counters. And Nikki, finally, Ramco Cements, a brokerage note giving it an upside of 25%.
Yeah, one more South-based cement player where we are getting an upgrade now. Upgrade to buy from sell coming in from CLSA with then a potential upside of nearly 25% to a target price of 930 per share, which is one of the most bullish brokerage call. Also, if you see, the upgrade comes on the back of earning growth acceleration, and also as the balance sheet continues to strengthen, given that FY18 was not a great year for the company given the cost pressures and also the weakness in pricing that we saw in the given year. Channel check suggests that demand has picked up in Tamil Nadu, which is a key state for the company. Costs have also peaked up and and ongoing efforts are expected to drive savings for the company. The volume growth, importantly, is expected to improve in a span of next 12 to 18 months for this company, given that new capacities go on stream. Net debt to EBITDA, which is a key parameter here, is expected to fall to 0.5 times in next 2 years as compared to a level of 1.5 times. And also it says that the Ramco is currently the top pick for CLSA. Bloomberg consensus pretty much has the same bullish call. If you see 17 analysts suggest to buy, 8 of them suggest and hold, and nearly 3 suggest to sell with a potential upside of nearly 5.8%. But then this call definitely is a bullish one.
All right. Thank you so much, three of you, and have a good day. Girish, you were also mentioning about the cement space, and I remember the Q3 numbers, the volume growth was pretty decent, especially from the larger ones, ACC, Ambuja, Ultratech. Going ahead, which are the pockets in the cement industry? Because even the sand mining issues have started to ease off. Any specific company that you as a house will be bullish on in the next 12 months or so?
Yeah, so one of the stocks that we kind of like in the cement space is JK Cement. It's a fairly unique story. It's a white cement play, probably the only other company besides Ultratech Cement which has got an exposure to white cement. So there the EBITDA per ton is fairly high, something like 3,500 rupees per ton is the kind of EBITDA that one kind of makes on the white cement side. And the revenue per ton is somewhere close to 11,000. So we think that part of the business has got very high EBITDA margins, has got very high ROCs, and that kind of acts as a buffer to volatility in the grey cement prices. You know, when that goes up and down, this kind of buffers the earnings of this company. So we think that piece of the business should command a much higher EV/EBITDA multiple, and that constitutes almost like 50–60% of the total EBITDA of the company. So that's a stock that we think deserves a re-rating. I think the stock is probably at 900,000 or somewhere thereabouts. So we think we have a price target of close to 1,500 on that. So that's a fairly steep upside that we're looking at. But otherwise, we're a little concerned about cement sector. At least my analyst, we've kind of on the process of reinitiating coverage on the sector. We kind of worried about the fact that certain new entrants will be seen in the northern region. If say Binani goes to say Dalmia Bharat, for instance, that could probably upset the price dynamics in that particular region, this could also be the situation in other parts of the country. So realization growth, which one was expecting some time back, and this has been an expectation, it's like the earnings growth expectation of the index. You expect realization growth to pick up, that kind of gets pushed back, every few quarters. So that's the only worry on the cement side. But I think growth should be probably in the 5–6% kind of region for the industry this year, even in FY19. And JK Cement is a stock we kind of like because of the white cement exposure that's got.
Interesting. Of course, keep in mind, Girish said that they are in the process of reinitiating full-blown coverage on the space as well. So the detailed report a bit later on. For now, they have a positive view on JK Cement. Doesn't mean they have a negative view on almost everything else. Keep that at the back of your mind. Girish, you guys have come out with a lot of very interesting reports. We'll talk about some of those as well, and some stocks and news as well. Would want your thoughts out here. But it's 8:45, so at that time of the show, we delve a bit on the technicals as well. So Ruchit Jain, technical analyst at Angel Broking, as well as Dharmesh Shah, AVP for technical research at ICICI Securities. Both of them join us on the show. Gentlemen, both of you, good morning. Thanks for joining in. Ruchit, a bit of a recovery in the SGX Nifty, that notwithstanding. Does Friday's fall damage the intermediate charts, and if so, what's your trading strategy on the index for the week?
Hi, very good morning. Yes, we have seen that during last week on Friday's session when the downfall came, it was not that some of the large caps had led the corrective move. It was a broad market participation on the downside. And secondly, the last weeks of activity has led to formation of another lower top on the daily charts. So this is definitely a sign of concern. No doubt that 200 DMA, which everyone is watching for, that needs to be breached for continuation of this corrective move. So 10,120, which is the recent low, would be now a crucial level to watch out for. If this 10,120 is broken, then I think within no time we would see sub 10,000 levels. So for index, one needs to keep a strategy to sell below 10,120, and once that support is breached, you can keep a stop loss about 10,240 and expect targets around below 10,000 levels.
Okay, that's the view coming in on Nifty. And remember, just in the last 15 to 20 days, Nifty has defended the 200-day moving average twice or thrice. If that gets breached, probably the selling could actually be accelerated. But Dharmesh, what is your call on the index, considering we're around the 10,200 mark? Would you suggest anyone to create fresh positions or just wait it out?
Yeah, good morning. Yeah, definitely. I think so. If you look at the market, I think so. The market has a lot of event in the current week, as we have domestic as well as the global event, which will track the market going forward. We believe, I think so, the trend going forward believes that the market has a strong support in the range of 10,000 to 9,900 for 2-3 reasons. Being, if you look at the market since CY10 market, there has been the 4 instances where Nifty has made a 7 higher high, higher low on the weekly chart, after which the Nifty has been witnessing its 8 to 12% correction. This time also, if you look in the current last 2 to 3 months, in January we have a 7 weeks of a rally, and then after we are witnessing almost 8 to 9% of corrections. So we believe, I think so, 9,900 to 10,000 has been a very strong support for this one reason. Second being a 38% retracement from 7,900 to 11,171 remains to be in the range of around 9930. 9975 is also a 52-week EMA which Nifty has been respecting since long time. So we believe, I think so, for 2-3 reasons, Nifty has a strong support in the range of 10,000 to 9,900. So going short at the current levels could be a bit of a risky, because Nifty has been the oversold at the current level. So we don't believe to go short, but definitely we will look at the reversal point in this range of 10,000 to 9,900, where again one should look for buying opportunity. So buy on dip should be the market strategy going forward.
Well, let's try and figure out what stocks to play in for today's session. Ruchit, I'll come to you first. Your stock recommendations for the day?
Adani Ports. If you see the daily charts, then during 2016 was the first time when the stock moved higher about 200 DMA, and which led to an uptrend in the stock. Now, after a period of almost 1.5 years, we have seen the 200 DMA getting breached in this. And if you just see the volumes that during this breakdown, then the volumes were quite high when prices breached its 200 DMA support. So the short-term trend continues to be negative. Since after a long time the prices have breached this support. So one can go short in Adani Ports, keeping stop loss about 383, expecting target around 352. And I have a buy recommendation in Tech Mahindra. Definitely this IT pack, everyone knows that this has been one of the outperforming sector in this calendar year. Tech Mahindra is one of the stock which has been continuously forming a high top, high bottom structure. The weekly chart structure still looks quite strong. So the downside seems to be very limited irrespective of the market moves. So one can buy Tech Mahindra keeping stop loss below 602 for targets around 690.
Okay, so one buy and one sell call coming in from Ruchit this morning. Dharmesh, what about you? I guess you've got 2 buy calls for the day.
Yeah, we have one positional calls on Titan. I think so. The one Titan has been in the consolidation in the weekly. If you look at the weekly chart, it has given a breakout in this last week after the 4 weeks of consolidation. So we believe, I think so, Titan, clearly the outperformance seems in the Nifty stocks. So we believe, I think so, the Titan likely to head towards 938, which was the previous high, keeping a stop loss of 949. Coming to one intraday strategy, we also like positive on the TechM. TechM has been if you look at the long-term structure of this chart, has been the positive. Also the weekly has been making the higher high, higher low, and the last week has also been able to maintain, even though of a volatility, it has closed on the positive side. So the recent breakout level retesting, we believe intraday strategy where Titan could be looking for a target of around 644. Buy on declines towards 630, keeping a stop loss of 624.
The positional call so far on Titan seems to be working even when the market is weak. Last week on all 5 trading sessions, Titan ended the day in green. So watch out for this counter. In the last 1 year, it has given good returns of nearly 90%. Well, moving on to our special segment, Bloomberg Edge, where Jayesh Khilnani tells us about a pattern that a Bloomberg terminal has thrown up on a stock. Hi Jayesh, good morning. What's on your radar today?
Morning, Navneet. I'm watching out for Z Entertainment on 2 primary reasons. One is the stochastic indicator has given you a buy signal, and the stock price is trading very close to the 100-day moving average. Stochastic suggests that it will break below this. Let's have a look at how the stochastic actually works. Stochastic shows you when a price move is actually overextended, and it measures where the current price is in relation to the recent high or the recent low that the stock would have made for itself. A few conditions that you have to keep in mind. is where the overbought condition above 80 and oversold is below 20. Two lines which get plotted, those oscillate from 0 to 100, and during this course, a crossover between the two lines gives you the buy and the sell signal, depending on the direction of the crossover. Let's have a look at the chart of Z Entertainment. So that's the last 6-month chart, and you can see the the bold white line, that is the 100-day moving average. So it has been trading very close to that range, up and down. And as per stochastic now, we can see that the blue line has crossed below the white line, and both of them have actually closed below the red line, which is the overbought signal, which suggests that there could be further downside pressure on the stock.
Okay. History, Jayesh?
History works well for Z Entertainment, and net profit would be about 14 to 15%.
Okay, do watch out for Z as well. So that's, well, a fair bit of charts for all our viewers. Jayesh, thanks for putting that or bringing that Bloomberg Edge for us today as well. I'll take a leaf of a conversation that we just had with one of our experts, Girish, and dwell on IT for a bit. You have very strong views, I know there. My question to you is this bout of outperformance that IT is given in the first 2 months of the current calendar coming to an end? Do the valuations now start to worry you a bit, especially at the mid-cap end?
Yes, so we've kind of put out a note today where we've kind of become tactically positive on the sector.
Oh, okay.
So we've been negative on the sector for 3 years until December 26th, when we kind of put the ratings under review for reassessment of a hypothesis. So we put out a report today where we kind of are saying that because of technical factors, not so much to do with fundamental reasons. Fundamentally, I think the growth is going to probably look up in FY19 a little bit more than what Street was anticipating a few months back, maybe by 100 to 300 basis points, across individual stocks. But we don't think the sector is going to go into a double-digit growth territory from here on. So even in the best years, which is what 2018 is probably going to be from an economic growth standpoint for the US, we're still not going to see double-digit growth. So my call is that technically, because the fact that institutions have been seriously underweight IT services and have been overweight financials, where the financials are seeing pressure because of asset quality issues, because of interest rates and stuff like that. So you have this dichotomy out here. I mean, you have two parts of the market, which one hugely overweight, one underweight, and the fundamentals are moving in opposite direction. So we've seen a little bit of outperformance. I won't say little; it's been quite a bit in the last 6 months between the Nifty IT and Nifty. But I think it can continue for some more time to come until the prospects of financials start looking better. From a valuation standpoint, I think the upside isn't too great. I think a lot of that has kind of played out. So the kind of change in target prices that we've done, 80% of that has been because of PE multiple expansion, and only just 20% has come from earnings expansion. So it's still not a fundamentals-driven story. It's more of a a technical story, which is to do with underperformance, underweight position, a little bit of improvement in the fundamentals, so to speak. So that's the kind of picture. So I'm a little worried about the mid-cap side, where the stocks have kind of shot through the roof. I think that yes, FY19 could be a good year, but considering the kind of business metrics that the mid-cap companies have, I don't think that growth is sustainable. A lot of these companies have top 10 clients at something like 50-60% of their revenues, and a loss of one of those clients, which can potentially happen anytime, it can lead to a situation where growth will have to be growth rates will have to be brought down. So I see a lot more risk in the mid-cap side. The valuations there are looking very rich right now. But I don't know, the sector, that particular space, could potentially continue to hold on for some more time, in my view.
Okay, slightly close to pre-open, but Girish, just one quick question. I actually wrote a piece on that, the mid-cap valuations as well being very stretched. We just spoke to Mindtree last week, and while promoters have been selling stake, that's one thing, but Rosto Ravanan mentioned that he foresees double-digit growth for the next 4 years at least, if not more. He was having that visibility. I mean, that brought my hypothesis into question as to which sectors do we have right now currently which have a double-digit revenue growth visibility for the next 4 to 5 years?
No, I really doubt whether any tech company can say with certainty that it has got visibility over the next 4 years. I mean, I think at best you got visibility over the next 6 to 12 months. So as I said, when you have companies with top 10 clients forming something like 45, 50, 60% of revenues, one client gets taken away by a tier 1 player because of vendor consolidation or whatever it be, leads to a drop in growth rate. So we've seen this happen even with Mindtree in the past. So I don't know with what certainty he's saying that he has visibility over the next 4-year time frame. So yes, FY19 could be a good year, but beyond that, I don't think that's the case. So if you look at the bigger picture, next year FY19 earnings growth is going to pick up. You will see tier 1 earnings growth at single-digit levels. In the best case scenario, we're talking of high single-digit levels in the best case scenario. So still, I don't think it's a sector to bet on from a secular perspective. A trading perspective, maybe, yeah.
Okay, that's the view coming in on IT. We'll delve more into that, but the pre-opening rates are there on your screen, or rather they'll just come up. SGX Nifty currently trading, actually it's recovered majority of its losses that we saw in the morning. Okay, so those are the first trades there on your screen. Don't go by them. They're only going to settle in the next 5 to 6 minutes of trade. Currently, we're actually seeing a major positive ticks, but it will be corrected in a while. I just want to check few stocks. Tata Motors, that was the top loser among the Nifty constituents on Friday. Remember, hitting its fresh 52-week low, the underperformer on YTD basis among all the Nifty constituents. So finally, Tata Motors today, this morning, at least in the pre-opening rates, is showing an uptick of nearly 1 to 2%. Let's just do a check for a couple of the other stocks. Adani Ports is showing a green tick on my screen. Ambuja Cement too is starting the day on a positive note, but on the losing side, a couple of these banks, IndusInd is showing a negative tick, NTPC, Indiabulls Housing, BPCL are the ones. No major losses, remember, but just the rates will still be settling. Now you can see the positive ticks. Among the stocks which will be in focus today, if you could just pull up stocks like Z Entertainment, because the company has called off their deal to acquire 100% equity stakes in a couple of the 9X entities. So there's no trade which has taken place right there. Thermax and PNC Infratech on back of order win will be in focus. So let's see if there are any positive ticks. 3% higher for Thermax in the pre-opening rates as we speak. And for PNC Infra, which has emerged as the lowest bidder for Aligarh and Kanpur project, is also starting the day with gains of 1.5%.
Well, I just want to mark two or three names. One of them is JP Associates. Big move all of last week and also in Friday's session. Rakesh Junior checks into the counter, another 1.5% higher. So interesting out there. The likes of MMTC, ITDC, Canara Bank, though not usually very liquid names, but have been very liquid of late. And boy, we've seen some traction there early in trade as well. ITDC, Canara Bank, amongst others. So interesting too. And lastly, NBCC, the stock will remain in focus. Last week, the CMD got a clean chit in that corruption probe. That revved the stock up last week. Now they've entered into a road construction space. And that's an interesting move by NBCC, honestly. But they won a 2,000 crore order and the stock starting off about a couple of percentage points higher. By the way, just want to mark the currency as well. The macro data that came out post market hours in Friday wasn't the most positive. Maybe that's having its impact on the currency as well. 65.03, a bit of weakening compared to the dollar in early morning trade. However, 9:02, before we continue our conversation with our expert, let's get into Samit Sarkar, who joins in with the big brokerage calls of the morning. Samit, good morning.
Good morning, Neeraj. On the big brokerage calls for the day, first we have is IDBI Capital on GMR Infrastructure. Now, the brokerage has initiated coverage on the stock with a buy rating and a target price of 32, which suggests a potential upside of 78%. Now, according to the brokerage, the upcoming restructuring events for the company are important and will lead to re-rating for GMR Infrastructure. Now, first is the stake sale in the energy business, that is GMR Energy, which will be followed by divestment of its road assets and monetization of its land bank. Now, this restructuring move is signaling right capital allocation according to the brokerage. Also, the TDSAT ruling, which is due for a long time, will re-rate the airport assets of the company, says the brokerage. Lastly, it says that the GMR Infra is the top pick in industrial stocks. Second, we have is Jefferies on telecom. Now, they have assumed coverage on all the three telecom companies. For Bharti Airtel, they have downgraded the stock to underperform from hold and have cut the target price to 365. Now, for Bharti Infratel, they have maintained the hold rating and has cut the target price to 300. 300 from 385. And for Idea Cellular, they have maintained the underperform rating but have cut the target price to 68 from 70. Now it says that the profitability of the telecom companies will remain under pressure for the next 12 months. It is expecting the average revenue per user, that is ARPU, to improve from mid FY20. For Bharti Airtel, it is saying that it is the best place to face the competitive threats, and it is expecting overall market share gains from the company. For Idea Cellular, it is saying that there could be a substantial market share loss and a drop in its margin despite merger synergies. And for Infrared, it is saying that the near-term growth would remain subdued because of exit of smaller operators.
All right, Soumya, thanks a lot for bringing the top brokerage calls for the day. And talking about the brokerage calls, Girish, I was just reading a note by Deutsche Bank this morning where it has come on the Indian consumer space, where they have suggested they do see a price-led growth now to come in FY19. And talking about this space, we've seen good gains from companies like Jubilant FoodWorks, despite of markets being weak. Godrej Consumer has managed to put up a good show. And I remember as a house, Nirmal Bang, in the last few months, you guys have been positive on a couple of MNCs like Colgate and all. In a year where there's going to be a lot of volatility in terms of political scenario, globally, I think we'll be watching out for the FOMC rate hikes, how many rate hikes take place or not. Do you think as a defensive space this can outperform?
So we are positive on the consumption space from an overall standpoint. So whether it be consumer financials, whether it's consumer electricals, or consumer durables, whether it's consumer staples, we've been fairly positive. So within the consumer staples space, we like Hindustan Unilever. So we think that the volume growth has been very poor until a quarter or two back, and that's been the case for many years now. I think the volume growth has kind of picked up, and we're seeing our analyst believes that that could be between 5 and 10% going forward. And the premiumization story and the margin expansion story, we believe, will continue going forward. So we are expecting EBITDA margins to climb up from about 20% or thereabouts, which was the number in FY17, to as much as 24-25% in FY20. So that's a fairly sharp expansion in margins, driven largely by premiumization and a little bit of volume growth pickup. So that's the story we like. We still like the stock. I think our target price on that is close to, if I'm not mistaken, 1700. So that's a large cap stock that we like in the consumer space. The other stock that we like is Britannia, where we have a target price of about 5,850 or thereabouts. So there it's a question of product innovation that's kind of been happening, distribution expansion, premiumization again kind of playing out. So again, we think that stock, it's trading at a reasonably steep PE multiple, but we think that that PE multiple can continue to sustain going forward, because we think that the company's been delivering steady earnings growth, and which can continue going forward. If you look at the other areas in consumption, one space we like in particular is the consumer durable space, where we like players like IFB Industries, we like Whirlpool. IFB Industries is a particularly interesting case where we think that EBITDA margins can almost double over a space of 3 years, from FY17 to FY20. So my analyst believes that 5.6% EBITDA margin can go to as much as 10.5 to 11% EBITDA margin by FY20, driven by revenue growth, which is going to lead to economies of scale. There's a localization story that's kind of playing out there. So those are the drivers of the EBITDA margin expansion that one will see, and we'll see very strong earnings growth come through for IFB Industries. So that's the, and Whirlpool is the other kind of play. So it's a play on, again, low penetration, expanding product portfolio, expanding distribution, electrification that's happening, housing. So all those are like coming together to drive this. And this is a multi-year kind of a growth story on the consumer durable side, which is where we are fairly bullish on at this point in time. Obviously, there are other areas like private banks, autos, and that's the broad consumption space that we're talking about.
Oh, interesting. And they came out with some very interesting notes as well. We'll probably discuss one of them in just moments from now. I remember Sequence Scientific, and I remember 3M India, if I'm not wrong.
No.
Not 3M, but Sequence Scientific.
Yeah, I don't recall the actual details of Sequence Scientific.
Yeah, but there is a stock that reacted quite a bit post that report too as well. So we'll talk about all of those, but it's 9:08, so the pre-open rates seem to have settled, and we have a bit of green on the Nifty. Just want to dwell a bit on the charts as well. We have a bit of green on the Nifty, so it's good going really. Good going because it didn't seem like so at about 8 a.m. when the SGX Nifty was indicating a level which was very close to that 10,000 which would have taken us close to those 10,175 or slightly lower levels than that. For now, it seems like we'll start off about 10,215. Dharmesh was talking about buying dips. Dharmesh, let me ask you, at 10,215, it doesn't seem like a trend, but would you go out and initiate any kind of positions at these levels on the Nifty or the Nifty Bank? The Nifty Bank looks like starting off about 30-40 points higher.
Yeah, definitely, I think so. I will look for the dips to buy. I think so. We believe, I think so, 10,140, 10,160 range has been a very strong support for the Nifty from the intraday perspective. So we believe, I think so, around those levels, if we get levels around 10,160, 170, we will definitely look for going long in the Nifty at lower levels, but not at the higher levels. One would wait for the event to get pan out. So buy on dips should be the strategy. Coming to Bank Nifty, I think so, we believe, I think so, 25,100 remains to be the very strong resistance for the Nifty, because the Bank Nifty. Because if you look in last 2 times, Bank Nifty has been facing a stiff resistance in this range. So coming to Bank Nifty, we believe, I think so, more for trading range is there in the Bank Nifty, where 24,000 on the lower side remains to be the strong support, and the higher side 25,100. So the overall view comes to more for consolidation, either for the Nifty or for the Bank Nifty.
Right.
We will not see a major break or major upside move for the Nifty going forward.
No major upsides, buy the dips if at all. Ruchit, a quick thought on NBCC. The stock was a star last week, 9 or 10% higher, likely to start off a couple of percentage points higher. Would you trade this?
I think if I have to just look from a short-term trading perspective, then yes, last week the volumes were also quite good on the pullback move. So I think this pullback move could get extended up to its resistance of 218. So just from a short-term trading perspective, one can initiate long positions, keeping stop loss below 194, expect target around 216 to 218.
Okay, let's tell you all that you need to know to stay ahead in trade just minutes away from market open. So here are the top stories. PTI reports that Indian Oil and BPCL may buy government's 26% stake each in GAIL, the stock starting off about 1.5% higher. Likely to start off 1.5% higher, excuse me.
Vanguard Group has bought stake in Graphite India, HEG, Capital First, and also Eris Life Sciences via block deals.
Real estate stocks in focus as Maharashtra allows a cut in the ready reckoner rates, according to reports in the DNA.
Hotel stocks may see a reaction after the government granted infra status to hotels worth over 50 crore rupees, as per reports in the Times of India.
And in brokerage calls, IDBI Capital sees a 78% potential upside for GMR Infra, while CLSA has upgraded Ramco Cements to a buy with a target of 930 rupees a share.
And Thermax has won an order worth 503 crore rupees, while PNC Infratech is the lowest bidder for an order worth 1,197 crore rupees.
Okay, 3 minutes to go before markets kick-start trade. Girish, you don't seem to be too bullish currently, and with reason. IT is probably an outlier. Any other outliers do you think which will outperform as a bucket? I think consumer durables is one, but doesn't have too much of an index presence. Anything else there?
So I think one space, if you take a 3-year view, which I'm quite bullish on, are the private corporate banks. Okay. Yes, they will face earnings pressure and provisioning pressure in Q4 and probably going into the first half of FY19. But the way I look at the private corporate bank situation over the next 2 to 3 year time frame is that I think much of the growth in the project finance side is probably going to go towards the private sector corporate bank side, and because PSU banks have been losing market share. But within the project lending space, I think PSU banks will continue to lose market share to the private sector corporate banks once the cleanup finishes, because they will not have enough capital to actually grow. Whereas you have private corporate banks in a situation which are fairly well capitalized. So within this whole market share shift space, within the corporate banking, within the corporate finance and the large project finance area, I would think that private corporate banks will gain a lot of market share. Yes, they also have a balanced mix of retail and corporate bank business. But within the corporate bank business, I think they'll gain a lot more market share going forward, because I think the PSU banks may not be adequately capitalized going forward.
Do you see more consolidation in the PSU space?
Yeah, I think within the PSU space, I think government will force that over a period of time, but maybe not in the next 1 year with the elections probably on the anvil. It's probably going to be taken up by the next government. So Consolidation, yes, within the PSU space, it's very likely, but not maybe in the immediate term.
Okay, Girish, thanks a lot for joining us today and taking us through your thoughts on the markets. Well, the markets are about to open in a minute and a half. But meanwhile, I just wanted to highlight Ramco Cements. Remember, there was a note from CLSA suggesting 25% upside for this counter, and that's showing an uptick of nearly 3.5% in the pre-opening rates as we speak. Also, you've got Neeraj already highlighted NBCC, so that's also trading in the positive. But watch out for GMR Infra. There was a brokerage report there as well, and that's also showing an uptick of nearly 1.5%. And stocks like United Spirits and also Titan, remember that stocks has not succumbed to the selling pressure that one has seen in the markets, at least in the last 4 to 5 trading sessions. So Titan also is showing some bit of positive tech, Neeraj.
Well, let's take a look at the top call then from both our experts. Ruchit, to you first. Your top stock for the day today.
For the day, I would recommend buying MCX. If you see the daily chart, last week on Thursday, prices have given a breakout and with very high volumes and a first higher top, higher bottom structure after a long period of time. So one can buy MCX, keeping stop loss below 782, expecting first target around 835 and then around 850.
Dharmesh, very quickly, one stock from your end today, your top call.
Yeah, I think so. I believe Titan should be looking good for the day. Also, where we look for target of around 898, keeping a stop loss of around 880.
Okay, gentlemen, just stay on. We'll take in one final thought from you post-market open as well. But here's the market open this Monday morning. We're actually faring a bit better than what the SGX Nifty was indicating. So about 0.25% in the green. Let's wait and watch if this lasts. The Nifty Bank, about 0.25% as well. So 47 odd points. We're doing reasonably okay at start, but this may fade away as well. So we'll wait and watch what happens. The mid-cap end of the market will come up on your screen, about 1/3%. This, along with the large caps, really got crumbled in Friday's session. In today's trade, starting off on a fairly decent note, about 1/3% now for the small caps. That's not a bad start considering what the rest of the Asian markets were up to. And a fair bit of green as well. Maybe we underperformed in Friday's session. We definitely underperforming for the month of March. So this shouldn't surprise people that we are slightly decoupled from what's happening across the world. But let's wait and watch. Vedanta, Dr. Reddy's, Cipla, Sun Pharma. Clearly, pharma seems to be that one bucket which is starting off on a good note. I can see a clutch of pharma names in the set of greens. Some commodity names doing okay. And oil marketing companies not doing the best. IOC, BPCL, both of them, HPCL too in the red. So that OMC pack is not having a great day. Pharma companies are. I just want to see TCS once on the screen. It was a very subdued performance last week for TCS. Today, this week, or rather today, starting off about 0.25% higher, still subdued, but not in the red, which is not a bad sign. 2 or 3 sets of stocks that I want to mark before I hand it over to Navneet. These are, well, the top movers and some newsmakers, a couple of newsmakers in the session today. So CLSA sets a target of 930 on Ramco Cements. That stock starts off about 1.5% higher. So not a bad start to Ramco considering large cap and mid cap cement had a slightly iffy last week. These are the best performing stocks of last week and arguably of Friday as well. And each of them starting off on a marginally positive note. But MMTC is the big one, which starts off about 3% higher. So this one is having a good start today. Last but not the least, NBCC. A road business foray. They have won a construction order worth 2,000 crores, and that stock, after a 9% move last week, starts off about a couple of percentage points in today's session. Navneet, what are you spotting?
Well, Neeraj, it's a positive start for the broader markets as well as we speak. Let's just pull up the Nifty Mid-Cap Index. It's just marginally coding in the green as we speak. 0.2% higher is what I checked. But also stocks like NMDC, that's falling quite sharply in today's session. Pull up NMDC. Remember, it went up in the last hour of trade on Friday, and it's showing a downtick of nearly 4% as we speak. NMDC at 121. Besides that, BPCL, that's the one which has seen cuts of nearly 2%. Remember that PTI story where BPCL and IOC together are looking to buy government stake in GAIL. Steel Authority, that was down 3% on Friday. Once again, some selling pressure continues for this one as well. Whereas on the gaining side, you've got stocks like IDBI Bank trading with gains of 2.5%. Ramco, Neeraj highlighted, Reliance Communication, Group Finance, and also stocks like NBCC, Indian Bank are trading in the green. I want to pull up Graphite as well as HEG. Remember, Vanguard Group bought stake in both these companies via bulk deals in Friday's session. Graphite, as we speak, is locked in upper circuit with gains of 5%. Let's just pull up HEG as well. That's seen gains of 10%. So watch out for these two stocks, the graphite makers, in today's trade, as a good amount of gains have been seen there. Also pull up VA Tech Vabak, where Purenju Elliott bought almost 0.3% stake, 2.5% higher for this counter as well. And order wins, stocks like Thermax, PNC, Infratech, and also IRB Infra. All these stocks are also starting the day with a mild bit of green, so 2.5% higher for all these counters, Neeraj.
Well, interesting start. United Bank has a 10% uptick, so that stock is moving up very well, and not too many losers. NMDC marginally off, and some of those PSU names are coming off, the likes of ITDC, etc. A couple of percentage points lower, but nothing too dramatic. Final thoughts from our technical experts, though. You've seen the start. Ruchit, anything that pops up on your screen? Any trades or any thoughts on the index or any of the specific stocks?
I think since we are trading quite close to this 200 DMA support, so such pullback moves are not a surprise, given the positive opening. But I believe that unless we see any kind of higher top, higher bottom structure, the undertone would remain cautious, and 10,120 would be crucial level to watch, which is 200 SMA support as well as the recent low. So any long positions, whether it is with the index or any kind of high beta stocks, 10,120 on the index should be the strict stop loss.
Dharmesh, would you take any call or a position on NMDC, which is lost nearly 3 to 4% in the opening session?
Actually, I don't track the stock, so will not be able to comment on the same. But definitely coming to Nifty, I think so. Again, I would repeat, I think so that the 10,140 remains to be the very strong support for the Nifty, and this Nifty has been into the oversold territory. So going aggressive short at this point of time could be a bit of a risk. So I would advise, I think so, one should look at the basing formation for the Nifty before going any shorting positions.
Okay, gentlemen, both of you, Ruchit and Dharmesh, thanks a lot for joining us this morning and taking us through your technical views on the markets. Before we go across to our next guest, I just want to pull up Sona Koyo. Watch out for that counter in today's session. The promoters will be selling some stake because the promoter holding is above that threshold of 75%. There is an offer for sale. 107.7, that counter is seeing a downtick of nearly 3% in the opening session, Neeraj. Okay, let's move on to our next guest. Rajat Jain, Chief Investment Officer at Principal PNB Asset Management Company, joins us on the show now. Hi, Mr. Jain. Good morning to you, and appreciate you joining us this morning on Bloomberg Quint.
Thank you. Thanks so much.
Mr. Jain, what's been the reading on the markets, the sort of correction that we've seen in the last few trading sessions, and especially if you look at the fund flows on the market internals that one has been tracking for a while, looks like the support from the domestic institution is waning out now.
Well, last year, calendar 17, was a great year in terms of fund flows and in terms of what the markets did. So index was up all the way from 30% for about the Nifty to something like 55% for the small cap index, plus strong flows last year. In these first 2 months of the year, that is Jan and Feb and March, actually, one that we have seen, actually fund flows have remained positive in our funds, certainly, and there have been some slowdown of late, but the net numbers still are very much positive. So yeah, I don't think investors are turning away from equity markets, not at all. So fund flows are remaining good. Our view on the markets for this year is, the markets do not go up in a straight line. So the markets were up strongly last year, and last 3 odd years they've done quite well. So yes, probably this year is going to be more of a, probably more of a time correction sort of a scenario than much of a price correction. So probably markets go up, but marginally. Probably high single digit sort of move in the markets, because we see earnings are coming back. We do see that the consumer, especially the rural consumer, is doing quite good. When anecdotally talking to companies in terms of, they are very, very bullish on consumer demand. So overall, I think the scenario at the micro level is looking good. So we think the markets, having run up substantially in the last couple of years, probably take a more of a breather this year.
Okay, just want to highlight the markets as we speak. There has been a sharp fall once again. Remember, these opening gains, we've not been able to sustain them in the last few sessions. So as we speak now, Nifty is trading below the mark of 10,200, 10,178, down nearly 16 points. Bank Nifty, however, maintaining just above the level of 24,500 as we speak. Mr. Jain, what you highlighted, the fundamentals of the market, or let's say of the economy, according to you, still remain sound. So considering the sort of correction, no matter the returns this year could be in single digit, but the kind of correction that one has seen, do you see any fresh investment opportunity rather in any of the sectors?
Yeah, I mean, if you look at what had happened towards the last quarter of last calendar year, I think mid caps had run up substantially. In some cases, I mean, they were really trading at expensive valuations, whereas the earnings growth was not so strong for some of those companies. So I think this year, I think the markets will reward those companies where they have high visibility of earnings, where conviction is high. I don't think markets are in a mood to reward companies where it's only expectations and hope. Having said that, so I think partly in the mid-cap space things have corrected, yes. In terms of the sectors per se, our theme still remains. Our portfolios, for example, are aligned to cyclical, so we are long autos, auto ancillaries. While we are underweight financials because it's a very large space in the index, but we do have private banks, some select public sector banks. NBFC is not something that we have a whole lot of in our portfolio. We have reduced our underweight to IT in our portfolio. So I think overall our sense is that the cyclical recovery at the bottom of level clearly is strong. So I think we are better off playing that in our portfolios.
Mr. Jain, you think this, I mean, I will just draw the chat back to where we started off with. Do you think this bout of not really lack of flows, but when you balance out the inflows that are coming in via SIPs and other routes in the domestic AMC industry and the selling that's happening maybe because of the March pressures, do you think that will even itself out in the month of April? And would you attribute this really small sum of 300 crores that has come in the month of March primarily due to the balancing out of some bit of selling that's happening as a result of meeting up the selling in the dividend plans?
That may be so, but I really have no theory on that. So really, as far as we are concerned, we are still seeing net flows into the funds. Jan we saw net flows. February we have seen net inflows. March actually we have seen net inflows virtually on a daily basis.
You haven't gone out and made any kind of
house particularly we do not see.
And you haven't gone out and made any kind of sales in any of your dividend plans?
No, we haven't seen. We haven't seen that. We haven't seen a lot of redemptions, for example.
No, but you haven't gone out and sold either, is what I'm asking. I'm not talking about redemptions really. I'm asking if fund houses buy themselves.
No.
Okay.
No, I mean, for example, it's the same fund. It's all part of the same fund. A dividend plan or a growth plan is part of the same fund. So as a philosophy, do not keep large cash in our portfolios. I mean, for example, the largest cash in a fund we would have it about 6 or 6.5%. So no, we are not selling at all. I mean, that's the highest cash level we have in our portfolios.
Okay. Now, the other, somebody made a very interesting point this morning, Mr. Jain, that how does an investor invest in financials, considering that the overall financial earnings picture might be pretty distorted over the course of the next 6 odd months due to all of these resolutions, due to all of the bad loan menace that still seems to be here, and the resultant impact that it has on the index earnings over the course of the next 12 odd months. Do you park yourself in the expensive but predictable high CASA retail private sector banks, or are you as a chief investment officer taking some bit of exposure into either the corporate facing private sector banks or the PSU banks?
If you look at our portfolios, for example, if you divide the financial space into three categories, what you said, the high CASA, retail facing, private sector banks, corporate banks stroke PSU banks, and then the NBFCs. So we have had a substantial part of our portfolio in the what you said, the high CASA, retail, private sector banks, as also actually the so-called corporate banks and the PSU banks. I think the large PSU banks are as well run, they're as competitive, at least internally, in terms of operations and so on, versus the private sector banks. So we do have actually the large PSU banks. We do have banks who are both corporate and retail facing in the private sector. One space where we do have exposure, but not probably slightly lesser compared to what some other funds in the market would have, would be NBFCs. Because there we have seen more capacity in terms of a lot of people have raised money. I mean, it's just getting much more competitive out there. Valuations certainly are not cheap. So that's a space where we are slightly underweight, I would say, versus peers. But we do have a fair bit of in the large PSU banks, in the so-called corporate private sector banks and retail private sector banks in our portfolio.
Okay, the Bank Nifty 2 has slipped into the red, and NMDC, by the way, that counter has reacted negatively. The company had a board meeting on March 17, that Saturday, where they decided not to declare any interim dividend. Probably that could be one of the factors why such a sharp fall has been seen for NMDC, currently coding around the levels of 120. Mr. Jain, just want to delve on the topic of metals, which has been in focus, not domestic but globally, in the last 1 to 2 weeks, with US imposing import tariff on commodities like steel and aluminum. Do you see this triggering any sort of trade war, any other countries taking the same measure, and how do you see the Indian metal space reacting to this?
Actually, there are two parts to the question. One is about does this trigger a trade war? I don't think this measure by itself doesn't. I think we are still seeing that people are, since it's come under that's on the need for national security, so-called Section 232. So we see both countries in the EU, Australia, and so on are talking to the US, who are actually security partners to the US, as to why they shouldn't be getting exemptions into this, like Canada and Mexico have for a time being. So I don't think this by itself triggers a trade war. However, and China is not a big exporter of steel to the US, not even a top 10. I think India is the biggest exporter of steel to the US than China is. China is less than 1% of total steel sold into the US. However, on the other side of the trade war, US is looking at, I think under the Section 301, into the intellectual property rights issue that with China. I mean, there is a lot of, US claims that China is sort of not honoring IPRs of American companies. So that, and there's a full-fledged investigation going on to that. I think the result will come in the next couple of months. So, and that can be a serious issue. So this measure per se, I don't think leads to a trade war, but the fears of news on trade is going to remain elevated, and it's going to remain. I think that's going to make the markets globally quite volatile. It's to your second point about what does it do to steel prices or metal prices within India. It's possible that some metals do get pushed into India. But having said that, Indian metal prices are actually, steel prices are actually quite competitive now globally. So we have to wait and watch. We have to wait and watch, and that's a risk, but we don't think it's a very large risk at this point of time.
Okay, that's the view coming in on the metal space. Mr. Jain, what sort of cash levels is your fund house sitting on currently?
We generally do not have large cash levels, so it ranges from 4 to about 7% in our portfolios. 4 on the lower side, probably 7% on the higher side.
Would it be right to say that you guys are still putting money in the markets at these levels?
Yeah, I mean, if we do see opportunities, because some stocks do correct, especially mid caps, when there is substantial correction, yes, we would. look at those opportunities.
Jain, we'll leave it at that. Many thanks for joining us today and giving us that perspective. Have a great week ahead.
Thanks.
That's a view from Principal PNB. The market's lying absolutely flat. So no action right now. A bit better than what some of the other Asian peers are doing. But remember, we've been underperforming them for the month to date. So this shouldn't surprise anybody. The market's likely to remain on tenterhooks until a couple of global events pass away. For now, though, we take a break. On the other side, we discuss the dynamics of the IndusInd Bank Bharat Financial merger and the recent news flow on the securitization as well, with Mr. M.R. Rao of Bharat Financial inclusion a bit later on. We talk about the ready reckoner rates and the property tax cut possibilities with Gulam Zia of Knight Frank as well as Anuj Puri of Analyst.
9 to 5 job, अरे 5 to 9 job, भाग दौड़ all the time job. The roaming वाला job, the deadline वाला job, or are you living in the market वाला job?
Life is full of options. Choose a job and earn on your own terms. Choose to become an LIC agent. It's more than a job. It's career insurance. Be your own boss. Be an LIC agent. Ab life set hai.
Sir, please believe me, I am in this business for the last 12 years. Okay, I'll wait for your call. Thank you so much.
They still don't know you after all these years?
क्या करें? पहचान ही नहीं है.
Simple solution है. List on the stock exchange. With listing comes recognition. Investors get interested in you. And funding happens.
Come on, yaar. I'm not big enough to list. Chal, let's leave.
There's a stock exchange exclusively for your kind of company. NSE Merge. It's the right platform for your business.
Really?
Yeah.
My kind of company?
Exactly. Get listed, get recognized. अरे भाई हीरे की असली परख जौहरी को ही तो होती है. चल.
NSE Merge. साथ हमारा, सफलता आपकी. The SME Growth Platform from India's largest stock exchange.
White shirts, कितने plain और simple. Fog scent, plain और simple white shirt को बना दे special और fashionable. Fog scent, new fashion wear for men.
Okay, back with Indian Open right here on Bloomberg Quint. The Reserve Bank of India has given its approval for Bharat Financial to be merged with IndusInd Bank 4 months after the two lenders made the announcement. Joining us now to give us a guideline of what the entire process will be completed and what's the recent developments in Bharat Financial as well and the recent results that came out is Mr. M.R. Rao, the MD and CEO of Bharat Financial. Good having you, Mr. Rao. Thanks so much for joining in. Before I dwell on business at large, and we'll talk about that, just an indication of the timelines for this process, of the merger process?
Yeah, I mean, now the next two stages of the approval process are SEBI and the NCLT, post which I think we will go back to RBI again for final approval. And this should take a few months for the whole thing to get over.
Okay, so about 4 or 5 months would be a good enough estimate, Mr. Rao?
Give or take a month or here or there.
Give or take a month or here and there. Okay.
Difficult to predict timelines in a process like this.
Completely understand. Okay, let's move to business. You know, there's obviously in the normal course of business, you do securitize loans, and I think you've picked up the pace out there. Just wanted to understand how is business shaping up? I thought the one aspect that was maybe a temporary hindrance or maybe a temporary red mark, but a mark nevertheless, was the increase in the cost to income ratio for you as a company and for probably all of your peers as well. Why has this happened, and is this a process that will normalize itself, or will investors have to by and large live with a higher cost to income ratio for companies such as yours?
No, I think it's at a point in time the cost to income has risen partly because of the expansion and hiring of staff ahead of branch opening, because
okay, I think we've just snapped that line. We'll just try and repatch that line with Bharat Financial as well. I think as for Equities, for Bharat Financial, and maybe for Ujjivan as well, we've seen the cost to income ratio rise. Maybe not so disproportionately for Bharat Financial as for Equities, but for all of them, the cost to income ratios have gone up. Now, for certain companies like Equities, for example, the cost to income ratio uptick has also happened because they have taken a load of their costs upfront and provided for a clutch of their costs upfront, as also the hiring of fairly senior personnel in order to expand business. I think Mr. Rao was just about starting to say that they've made some hirings for the busy season, and which is why at this point in time the cost to income ratio has gone up, but in all probability will normalize. I think that's the hint that he was trying to give. Why that answer? We'll try and repatch that line. But that's an important bit, because from an investor's perspective, the proof is in the pudding. The cost to income ratio is elevated. Yes, it will come down. You don't know when it will. And when the cost to income ratio does come down, then people start making a beeline for the stock, so to say, assuming that the other market conditions stay all right. It's a factor of whether or not you can predict as to when that will happen, and which is where the management's commentary becomes very important. I'm told Mr. Rao is back with us. Mr. Rao, sorry, you were just making a point about how this has just gone up only at this point of time and will probably normalize in the near term. Can you explain that to us?
Yeah, so we've been making our intent quite clear and our plans to investors and the media as well, that over a period of time we ensure that the cost to income comes down to less than 40%. Thanks to our technology intervention in this business, our efficiency that we are planning, and customer acquisition. So I'm not too worried about this spike in cost to income for this quarter, because over the next 8 to 12 quarters, we will keep getting this down further and further.
Does this happen? I mean, will the normalization happen because of control in costs and because you would have provided a lot of one-time costs upfront, or would it happen because as a factor of the income moving up and the loan growth moving up, and that will essentially bring the ratio down? What do you think works out over the next 12 months?
It's a ratio, right? Cost to income. So there will be a lot of factors playing in. The key driving factor would be our singular focus on bringing in efficiencies through technology intervention. So, for example, we were the first MFI to give tablets to our field staff. So we have to get them to, get more efficient in the field. We have plans for customer acquisition based on our growth rates of 30% customer acquisition. We have to ensure that the customer acquisition is very efficient and from the same basis that we operate. All this will play out over, as I said, 8 to 12 quarters, and you will see that efficiencies will be the key driver based on technology. Will loan growth, the loan growth by the regular process of growth, and so on and so forth, will add to the cost to income coming down to less than 1%.
So, okay, let me break this up into two. We've spoken about cost. Let's talk about growth. I heard you mention customer acquisition growth rates of 30%, if I'm not wrong. First, I want to dwell on FY18. Are you on track to get that 40-50% loan book growth in FY18?
Yes, we are confident, as we have been right from the beginning of the year, that we'll meet our guidance for the year, both in terms of the profitability that we set ourselves and as well as the loan. And
how does this picture look like for for the first quarter or the first couple of quarters? I mean, does the momentum continue and spill over into FY19 as well? Or is it difficult to predict that right now? We are almost at the end of FY18 any which ways.
So the way we plan is that we will grow between 40 to 50% year on year. While there is a scope for more growth, we try to peg ourselves into 40-50%. Primarily driven by increase in customer acquisition by about 30%. The increase in loan book growth will come on account of two factors. Increase in customer acquisition by about 30%. And increase in ticket sizes by about 50 to 20% as customers graduate from one cycle to the other. That's the way we plan. And the customer acquisition is going to be more or less even throughout the year, just as we keep adding more branches and more loan officers. What you see as a customer acquisition in April, let's say, it could be, let's say, X. By December or January, it will be X plus Y because of increase in loan officers, increase in number of branches and so on. But over the year, we will end up getting a growth of 40 to 50%. The good thing about this business is there's no seasonality, not much seasonality in this business. So the growth, customer acquisition, everything will be kind of evenly spread throughout the year.
The problem is that on the provisions front, we're not seeing that seasonality. I mean, credit costs have normalized, things are looking up on the disbursements, AUM growth, etc., so on and so forth, but the provisions continue to remain high. What's the reason for the same, and what's your outlook on how provisions will shape up over the course of the next 12 months, or maybe this calendar?
So let me split this into two portions. One is we had an impact on the book or account of post-demonetization. That we have been stating right from the day of demonetization that this is a one-time impact and it's going to be controlled. We stated that our overall cost on account of demonetization could be 432 crores and be much lower than that. That's point number one. The provisions that you are seeing largely is on account of standard assets provisions that we make of 1%, which is far higher than what we are related to. That provision is going up because of our growth in loan. As far as the repayment rate is concerned, because typically provisions has a relation to repayments, all loans that we have given from January 1st, 2017 are clocking a repayment rate of 99.8%. So the business, both in terms of growth and repayment rates, for us, especially for us, Bharat Finance, is back to pre-demonetization level or back to business as usual.
Okay. Last question really. Almost everybody, Mr. Rao, is talking about how the rising cost of funds will be an impediment for NBFCs by and large. But management after management that I speak to seem to suggest that doesn't, I mean, even the kind of spike in yields that we've seen and maybe some bit of upticks coming in for the Reserve Bank, but that's a separate story. Just the rise in yields seem to suggest that while the cost of funds optically may go up, NBFCs and large NBFCs will be able to manage it. What's your view here? And if you can explain the how as well.
So primarily for us, we will do a lot of, actually 30% of our borrowings comprise of securitization and assignment, which is far lower than the normal term loans that we end up taking. And the plan is to do securitization because if the merger goes happens, the entire options. Part of the plan is to do some securitization and assignment. And given that this is a priority sector business for the banks, we don't see any increase in rates impacting our lending rates to our borrowers. In any case, we are operating under the 10% threshold that the RBI has guided us. And we have room to absorb some of the increase in interest rates because we are well within the 10% margin as of now. So we don't see, unless there is a substantial increase in interest rates, we don't see that impacting our business anyway.
Okay, Mr. Rao, you seem fairly confident and I hope it rubs off on the space at large. Thank you so much for taking the time out and joining us and giving us those perspectives. That's a view from Bharat Financial. Well, the merger obviously can't be predicted in terms of timelines, but about 5 to 6 odd months. Okay, now the discussion which we wanted to do next, which is not really from a perspective of an investment into real estate stocks, but a perspective into what could happen to property prices. Remember, about 3 or 4 weeks ago, we were talking to Anuj Puri about how the absorption rate in maybe tier 1 or at least in Mumbai and Bangalore seemed to be on a rise. And we've been talking about how the government is doing a number of efforts in order to push property sales, bring prices lower. And there is probably one more move. The government's draft ready reckoner, if implemented, will probably help in reduce the inventory, maybe bring down property prices as well. Lots to talk about with two very special guests, real estate veterans and in their own sense, Anuj Puri of Anrock Property Consultants and Ghulam Zia of Knight Frank join me in this discussion. Gentlemen, both of you, good morning and thank you so much for joining in. This is Neeraj here. Anuj, let me start off with you. I mean, last week, Purva, our reporter, filed a story of there being a possibility of property tax for flats sub the 700 square feet carpet area might be waived off completely. Under consideration, not known as yet, but the CM is on record saying that they are going to consider. Then there are these reports of how the revision in ready reckoner rates, and there is a gazette notification for the same being filed as well. Maybe April 1st we'll see that reaching the light of the day as well. What do you make of these developments, and would these lead to a further correction in property prices in Mumbai as also the tier 1, tier 2 cities in Maharashtra?
So good morning, Neeraj, and both the points are very valid, and let me just elaborate on the second point first, which is on the ready reckoner rate. In the past, we have seen is that every year, 1st of April, the government, state government, particularly Maharashtra, would increase the ready reckoner rates. And really at this moment in time, they were completely out of whack in comparison to the rates at which the transactions were being done. And several times representations were being made to the government to say, look, the ready reckoner rate, what you are publishing is completely beyond to the level at what transactions are done. So just for your viewers, let me tell you why the ready reckoner rate is important for the buyer. Because the stamp duty and registration charge is charged on the ready reckoner rate, not at the rate if the transaction is done below the ready reckoner rate. So by virtue of that, they were actually paying a lot more stamp duty and registration charge on a higher rate, which wasn't really prevalent. This time the government has come up and said is that we are giving flexibility to say is that either you keep it same or you bring it down. I think representation has been made by CREDAI and several other builder bodies to show that the transactions are being done at much lower value than what you are publishing. And I hope that for the first time after so many years, the government corrects the price. The moment the ready reckoner price gets corrected, your positive impact on stamp duty and registration charge comes in, because then it is at a lower price that it is going to be applicable, and the buyer will make that much saving. Today, unnecessarily, they were being asked to pay more, irrespective that they were actually buying the property at a lower rate. So why is the government doing it? I think his government has understood that the property market, certainly in tier 1 towns, is in a big problem. There is a lot of the unsold inventory that is getting built up, and clearly they need to push this through and bring out incentives, bring out some kind of a motivation for the buyer to be able to go ahead and buy. And that's where I feel is that after a long a request to the government, they have understood, and they, for the first time, 1st April 2018, in years that I don't know ever that they have done this before, hopefully they will be able to bring down the ready reckoner price.
Ghulam Zia, you want to weigh in on that? I mean, the provision, and please correct me if I'm wrong, but the provision never allowed for a downward revision, at least until recently. Now there is a change of provision if that does come about, and with an assumption that the government does go ahead and reduce the ready reckoner rates. Does that, plus the possibility of a property tax waive off, plus the strict implementation of RERA, at least in the city of Mumbai, everybody's talking about Mumbai as being the role model in terms of that as well. Do all of that finally lead to volumes picking up meaningfully in the city of Mumbai, which is arguably one of the largest market in India?
Well, to answer all the questions that you've put across, very simply, not yet. All these are, to the way we are looking at it, may not really excite the large masses of the buyers to come and start signing the deals. The reasons, first of all, there is no such provision that real estate rate on ready reckoner can only go up. Ready reckoner is only supposed to be a reflection of what's happening in the market. Unfortunately, there is a gap between the understanding of the market realities as far as the government surveyors are concerned, as Anuj just mentioned rightly. There is a lag in for them to really relate to it, accept it, absorb it, and then pass it on in the ready reckoner that the rates have come down or not. Now, that is something which is once again, as Anuj mentioned, people are waiting for ready reckoner rates to streamline so that the stamp duty implications are brought down, because otherwise they were paying, for no reason they were paying so much of money for the stamp duties and paying to the government. Now, your question was whether all this suddenly bring buyers back in the market. May not be so immediately, because while a lot of things that you're talking about are falling in place, the economic sentiments are not really falling in place yet. So the numbers, the GDP growth numbers, the employment growth, etc., that we're talking about are yet to really show on ground. And that is something which people are not really comfortable about unless and until there is a stability in wealth creation side, on job creation side. This may not really happen immediately, and the counter effect of the ready reckoner rates coming down also has to be weighed in, because what typically happens is government bringing the ready reckoner rates down is taken as a stamp of approval or a certainty that the tides have changed. All this while prices were going up, while in reality the buyers were paying less. But then there was always a question, how do you know? Can you really establish? Because the markets are not yet so crystal clear that I can really put across all the data and say here the rates have started coming down. But when the ready reckoner rates start changing the trends, says that now the rates have started coming down, here starts a different phenomenon altogether. It's something they call the falling knife. The buyers then are waiting for one more day to see some more price coming down. Yes, there are buyers who will still buy. These are the ones who genuinely need the house today on date for some reason, so they will buy. But those who can afford to wait for next couple of months, etc., will still wait to see really more of a correction coming down. The ready reckoner value is only an indication that the falling rate regime has begun. So there's a lot of these reasons for which I want to quickly and simply answer your question. The markets may not really turn so soon. I would say next year and a half would still to be watched, and let's not forget the general election also have a huge impact on real estate. During the years of general elections or main big elections, the real estate always takes a step back. Of course, immediately after the election, if the results are favorable, then there is a sentiment improvement and the markets start coming up again. But at least for next year and a half, if you're asking me, once again, markets may not improve so good.
Okay, we're coming to the end of the show, but I have a minute each for an answer from both of you gentlemen before we conclude this discussion. Anuj, would you agree with that? And the reason I'm asking you this question is, buyers anyways knew that if you go to a builder with a check ready to write, you are getting the ticket slightly lower, maybe 10%, maybe 15% lower any which ways. So that option was anyways available. If all of these measures lead to the ancillary taxes also being lowered, doesn't that induce confidence? And was probably that one reason why, I mean, we've seen buyers coming back in a meaningful way in the first couple of months of January and February in Mumbai and Bangalore as per your report as well. So would you agree with Ghulam on that front?
So I partly agree with Ghulam, Neeraj. Having said that, I can tell you is that I've just got about half an hour ago data from our sales team, Friday, Saturday, Sunday, which was Gudi Padwa. It is just outstanding sales that have happened. I mean, amazing. So it has beaten the record for 2016. It has beaten the record for 2017. Some of these developments, we've sold some 87 apartments, 102 apartments in 3 days. And these are solid developers. They are not at, 10, 20, 30 lakh rupees. These are, projects at 1.5, 2 crore rupees. So suddenly I do feel is that there has been some correction in the price. There has been some positive movement, good quality developers. Certainly the momentum is coming back into the market. Is to answer your question, I think is that initiatives like these will help to bring further momentum. But I think the momentum has started to pick up. You're right, January, February was good, but this Gudi Padwa, the last 3 days have been just outstanding. which I've not seen in the last couple of years.
Well, builders should be happy. Ghulam, final thoughts, and again, we don't have to agree on all the points, but just one quick thought on pricing, because you dwelt upon this, that ready reckoner rates coming off, if they come off, might be taken as a first sign of a reversal in prices. We already know that prices had come off a bit. Do you see further downsides here? We have about a minute, Ghulam, before the show ends.
Yeah, sure. Yeah, sure. As I said, this is only an indication that the prices have to streamline, have to really get back to the normalcy, because these prices were hugely inflated.
What is
and time will obviously prove that whether this actually
Ghulam, what is normalcy? 10-15% or more?
It can even be more. It can even be more.
Wow.
It can even be more, because for last 15-20 years, or at least about a decade and a half, we have been seeing the prices only going up at the rate of 8-10% per year, which is absolutely artificial, which had no reason behind this. Obviously, people do give you a reason that the land rates in Mumbai has shot up, but then land rates of Mumbai also shot up because people have been buying apartments at that rate, or people have been selling apartments at that rate. So effectively, the whole system has to correct itself and offer apartments which are at true value, and not what the inflation numbers that we look at, which have been the result of last 15-20 years of arbitrary increase time and again.
Okay. Jain, thank you so much for dwelling upon this topic. It's something that hasn't happened in at least Mumbai that I know of, and maybe the rest of the Maharashtra too. So thank you so much for joining in today and giving us those perspectives. Anuj Puri as well as Ghulam Zia, much appreciate your time. The market's just about 1/4% lower from where we started off. So no alarm bells, but in the red. With that, it's a wrap on this leg of Indian Open. Up next is the FNO show. Stay tuned.